Hey everyone, welcome in to another spellbinding, that's right, spellbinding edition of Market Takes. Listen, I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I'm your host, Dion Rabouin, reporter at the Wall Street Journal. Listen, there's a lot going on right now. There's a lot to explain, and I think we could be in store for a big, potentially market-moving week of data in terms of the information that we're going to be getting. It's going to be coming at us from all sides, but I have the three most important things to look for this week. I'm going to break down what they are, why they matter, and do a little separation of the signal and the noise for you. First off, we have this week's CPI inflation report. That is the big one that I think all eyes in the market will be on, but there are some other very key pieces of data we'll also get. Second, we get the NFIB Small Business Optimism Survey. That is out Tuesday, tomorrow. You're going to want to look at that. I'll explain why. And third, Congress returns to Washington, both the House and the Senate, later this week. So expect to see a lot of headlines about the debt ceiling. I'm going to explain what that is, why it matters, what to really look for in terms of what we get this week, because there's going to be a lot of information flying at you. I'll break all that down in just a minute. So let's start with the big one. First off, this week on Wednesday, we get CPI, the Consumer Price Index. We'll be right here on Market Takes breaking down what happens with that. What you're going to want to look for is, listen, inflation is still very high, still much higher than the Federal Reserve wants it, and that's shown in the data. So I want to put something up here on your screen right now, just give you an idea of what we're looking at. Now, we've seen inflation consistently coming down over that time period. You see it picking up through 2021 and into 2022, then it hits 9% in June, and it's come down every month since then pretty consistently. We are now at about 5% though. That's still more than double the Fed's target and still the highest inflation if you take out this 2021-2022 period, still about the highest we would have seen in 20 years. So lower, but still not low. The other key piece, this is another chart I want to put up here on your screen right now, and that is the core consumer price index. That's when you take out volatile food and energy prices. What you see there, the index doesn't go up as high. It doesn't reach that 9% level, but you see it start to pick up. And last month in March, or last month we got the report for March that showed inflation on the core side, CPI core inflation, rising to 5.6%. Now, why does that matter? I know what you're thinking, food and energy, that's gas and food, what I buy at the store, what I eat. That's most of what I spend my money on. And that's true for a lot of folks. But what the Fed feels like it can control, things that are more interest rate sensitive, are measured here by this CPI core number. And as you see, that really has not been coming back down. And in fact, it actually increased in March. And so that tells you that what the Fed's doing isn't having the intended effect. So this chart, these two charts really just illustrating the difference that we are seeing between the overall CPI and inflation and the core inflation, what the Fed watches and what the Fed thinks of as a predictor or a kind of indicator of where inflation is headed. If that's correct, inflation could be headed back up, and that's why you'll want to watch the CPI report that we get this Wednesday. Also, last week, if you were here with us on Market Takes on Friday, we talked about the jobs report, and we talked about how that average hourly earnings number picked back up last month, unexpectedly rose, and that could mean that inflation is starting to pick back up in the US. We also have seen around the world inflation starting to pick back up. You saw central banks in Norway and in Australia kind of surprise markets with a rate hike, as in raising rates after they thought, both central banks kind of thought they were done, and then boom, had to say, okay, well, inflation's picking back up again, we got to raise rates. You could see something like that from the Fed, maybe June, maybe further down the line. You're going to want to watch that report, CPI on Wednesday. Be with us here on Market Takes, 10 a.m. Eastern Time. Next up, the NFIB Small Business Optimism Report. I want to put up here on your screen a chart of what we've seen from that report in recent months. Now, this report, I want to point out a couple things. You see the downward trajectory, right? Pretty obviously going down. We aren't at those all-time low levels that we hit back in late 2022, but we are heading that way. The other thing you want to look for is you see the highest number, the highest reading that we've gotten since the start of 2022 was 97, right? Well, if you look back over the history of the survey, 49 years, almost 50 years, the average is 98. And we haven't even had a reading of 98 since the beginning of 2022. We are well below that. And if confidence continues to move lower, well, this is historically bad. Again, you would normally have about half the readings above that 98 number, half below. We have seen nothing but readings below that 98 number, you see. Nothing but down, 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 and below 98. That's the 49-year average. So we are seeing consistently declining sentiment among businesses. And that chart right there just illustrating that declining sentiment and how low sentiment has been for some time among small businesses. 15 straight months below the 49-year average. And that's really important because listen, small businesses have done all the net hiring since 2020, since the pandemic. All the hiring has been done by small businesses, and we are starting to see more small businesses cut jobs and actually reduce and have to lay off workers right as they were just starting to really pick up the pace and hire more workers. We're seeing that trend reverse in some of the JOLTS data that we've seen. Basically, the engine of growth for the US economy is starting to stall, and we are seeing that. I want to put one more chart up here on your screen that really kind of shows us what we've seen in terms of big companies versus small. That green line is the QQQ NASDAQ index. That's the NASDAQ 100 big companies like Meta, Amazon, Alphabet, Apple, all those huge tech names that you hear about. Those have returned over 20% year to date. Now in the middle, that red line, that's the S&P 500. That's done about 7% year to date. But that blue line you see, that's the Russell 2000. Those are those small companies, those companies more tied to the overall health of the US economy. That's basically been a 0% return for investors so far this year. So this illustrating really the big difference, the huge difference between what big companies are doing, how investors are putting their money into big companies, how they're putting their money into small companies. Obviously, investors having a lot more confidence right now in the bigger companies, those big tech names, and that's what we're seeing. So how could this affect the real economy? Because those small businesses we know are the growth engine. Small businesses are showing increased layoffs. The latest JOLT survey showed 72% of the increase in layoffs was from companies with 1 to 9 workers. 72%, almost 3/4. Those companies had about 185 increase in layoffs. That was about 72%. Firms with over 5,000 workers had a 0 increase from February to March compared to a significant increase from those smaller companies. You are just seeing a big difference between what's happening at large companies and small companies, and we're seeing it in terms of hiring and layoffs. So this NFIB Small Business Optimism Survey will be the first piece of data that we have seen that tells us what's happening with small businesses since this banking crisis, and we know small businesses more reliant on banks than big ones. We also get, as a bonus, later today we get the Fed's Senior Loan Officer Opinion Survey. That's going to tell us whether banks are tightening lending standards or loosening them. We are already at recession levels on that indicator, and we will see what the latest numbers tell us. Moving on to the debt ceiling, we get the debate can begin this week. The House is returning today, the Senate returns tomorrow. Really quick, let's step back and talk about what the debt ceiling is. Debt ceiling is just a cap on how much the US can borrow. We technically already reached the ceiling in January of this year, $31.4 trillion. We know that this has been raised pretty consistently. It had been just sort of a routine measure. Since 1960, Congress has increased the debt ceiling 78 times, most recently in 2021. 49 happening under Republican presidents, 29 happening under Democratic presidents. Really what it is just, hey, we got to pay for all these other things that we already paid for, that we already bought, and we have to pay for them now by borrowing more money. The US doesn't make enough money, anywhere near enough money in taxes to actually pay for the things that it spends money on, so they have to borrow money, and that's why we've got a national debt of $31.5 almost trillion, and that's where that comes from. And so that's got to be paid. And Fed Chair Jerome Powell said, listen, there's no reason we should even be discussing this matter, but Congress meets this week and you're probably going to hear a lot about that. So really quick, let's take a look at the timeline, right? April 18th was the most recent thing that happened. That was tax day. That showed how much tax receipts had come in, and that's why Treasury Secretary Janet Yellen had said, listen, we are going to, by June 1st, run up against the ceiling where we aren't going to be able to pay for certain things. She hasn't said what those certain things are going to be, but the Treasury has looked at how much money is coming in taxes. They've looked at how much money they have, how much borrowing they can do, and they've said by June 1st, we are going to have to stop paying for some things, and really Congress will have about a week after that to come up with a deal. Now, here's why this week and the week after are going to be so important. The House is out of Washington the week of May 29th through June 5th. The Senate is out from May 22nd to May 29th. So if they don't get anything done before the end of next week, They are going to be out. One branch is going to be out, and the following week, the next branch will be out. And at the end of that week, you're going to already run into that deadline that Treasury Secretary Janet Yellen says we are going to hit. So this week is going to be big. Next week will also be big. You'll hear a lot about that. The Treasury market is already showing some worries. If you look at the T-bill market, you're seeing some of those Treasury bills that mature around the time the debt ceiling comes due. Those have been raising in yield, which means declining in price, and you're already seeing investors react to the possibility of maybe not getting a debt ceiling deal. This week will be very important. If it looks like we're not getting a deal, you could see some Treasury yields start to spike. That could move the stock market as well as other markets around the globe. Hey, listen, that's going to do it for us here on Market Takes. Thank you so much for tuning in. I know you could have been anywhere in the world, but you were here with me, and I appreciate that. I'm Dion Rabouin, reporter at the Wall Street Journal. We'll be here Wednesday, 10 a.m. Eastern time to unpack CPI. Hope you'll be with us when we do it again next time.